Kitco Mining's special coverage of the Precious Metal Summit is brought to you by Nucor Gold.
The debt ceiling issue provides a much greater risk than currently perceived, says Tavi Costa. Tavi is macro strategist at Crescat Capital, a friend of Kitco. Tavi, welcome back.
Thanks for having me, Michael.
The news that broke today was the CPI number, a little higher due to the pop in gas prices. What did you see with CPI?
I've been of the view that we're probably in the process of bottoming on inflation. I think a lot of policymakers and investors has kind of been ignoring history. And if one thing we learned, regardless if it's the 70s or the 40s, is that inflation happens through waves. And I think we had the side of, the base effects working on the deceleration process first. That helped a lot of ultra long duration assets like technology companies. I think we're going to see the other side of that. I think inflation is starting to show that on the commodity side. Commodities have certainly started to move higher. Not only oil. I mean, if you look at agricultural commodities, they also have been doing very well. And the metals have been holding up okay. And uranium has been moving higher too. In housing is going to be a bigger and bigger question over time too. I think housing, the only way to fix the problem is going to be through an increase of supply. And that increase of supply has to come through, obviously, construction in the residential market. There's a reason why Warren Buffett owns home builders today. And in our view, that's going to kind of come to a full circle on commodities demand, because we're going to see materials being used for those construction developments in infrastructure and residential side. And so I think it's all going to come back to the inflation issue.
There's a lot of pieces that I want to pick up on there. First, maybe we can start with the Fed right now. The Fed said that it's going to be data dependent. What is it going to be doing with this piece of data, and what's the decisions it's going to be making next?
I think the market is way off when it comes to what's calculating in terms of the rate cuts that are already priced in the euro-dollar curve. I disagree completely. I don't think we're going to see 4 to 5 rate cuts in a year out. I actually think we're probably going to see even a slight increase in rates potentially because of this re-emergence of inflation. I think that's a very contrarian view. I don't think a lot of people are thinking that way. And that will then cause the economy to probably have some issues. Now, we're starting to see some tightening problems that has a lagging effect. The credit tightness is starting to show in some parts of the market, but not fully. The data is still kind of mixed. And so I think first we need to see that kind of reemergence of inflation due to structural issues. And that will eventually cause the market to completely priced out those rate cuts. And we start seeing potentially just rates staying higher for longer. And if that's the case, then equity markets have to suffer. And a lot of things are going to have readjustments due to those changes as well. So that's sort of the roadmap that I'm thinking from a macro strategist perspective.
Talking about those rate increases, when could we potentially see those then?
Well, I don't think the rate increases would be the extreme of that view.
Yeah. Okay.
If we just don't see cuts, would be a huge change in the curve. I think I would start there first. And then if we see, look, in my view, there's what are those structural imbalances? Let's start with the pillars of inflation that I like to talk about usually. First of all, we have de-globalization problems that we didn't have in the past. I think that's a huge change in the macro environment that we didn't see 20, 30 years ago. And that is mostly driven by one thing, in my view, that started with inequality. Inequality issues today wasn't something we saw in the 70s. And if you look at the net share of wealth by the bottom 90% of the population is today lower than the 0.1%. The last time we've seen this is in the 30s and 40s. And that was a populist time when a lot of political figures are very populist and they had an agenda, the nationalism. And what we saw coming out from that was de-globalization, the World War II. I'm not claiming we're going to see something like that today, but I think that it's all kind of entrenched in this chronic debt crisis that we have, along with an inflationary problem that a lot of people are ignoring. So inequality is an issue, de-globalization is a problem. Chronic underinvestments in natural resources is a huge problem. I think both of us, more than anyone knows that takes a long time for that capital to become supply. And a lot of those businesses in the copper space, and metals and mining in particular, will take a long time to be coming online. Oil space is also getting disrupted by the government. And the fourth pillar, which is involved with the government, is reckless fiscal spending. I mean, if you just look at today how much we're spending on the government side, it's about 25% of GDP, excluding interest payments. And so I think, obviously excluding tax revenues. And in my opinion, we didn't see this in other times unless you go back to war periods. So that is highly inflationary. It's hard to believe we're going to go back to the Fed target anytime soon. So that's sort of my, long-term view in this whole situation.
Now, Tavi, a year ago, when we were kind of at the start of this, it looked like kind of we were off to the races right now, especially around commodities and keeping with your theme in terms of underinvestment.
Yeah.
And then with gold, and then also what's happening with critical metals and copper. I think probably the surprise, maybe the story of the year has got to be China right now, with China really having some issues. And of course, China is just a hugely important consumer of metals right now.
Yeah.
Given the softness in China, and we're talking about real softness in China right now, doesn't that really kind of put a damper on the story regarding around underinvestment?
I think it does. It's not but from a macro lenses, I think you got to look at a multi-factor kind of analysis. That is one thing that certainly hurts the demand side of commodities, but the demand side is also coming from G7 economies, just like we saw in the early 2000s when China was entering the WTO and becoming kind of a global manufacturing plant. I think we're seeing the same with G7 economies. And regardless if it is the US, Canada, Europe overall, Australia, all those places are starting to build up infrastructure to reduce reliability with places like China. I think that's huge, and we're not talking enough about that. If you just look at residential, non-residential spending in construction in the US alone, it looks like the chart of NVIDIA. It's just, it's going straight up. And so that has to reflect as well the demand for materials, and the materials come from commodities. And so I think still there's a good chart I put out the other day looking at the CapEx cycle of technology companies versus energy companies. And that has been the case, a divergence between the two. We're now seeing a lot of focus on AI. AI is very capital intensive. And so a lot of capital is going there. But there's a huge issue in terms of an imbalance of money not flowing into resource industries still. And I think there's a lot of reasons for that. And I think it will change over time as those underlying securities, meaning commodity prices, start to rise. So yeah, China is an issue, but I think there's other things that are potentially a lot more important.
We started the segment talking about debt. Now, I believe that debt hurt a peak during the start of the pandemic, and that was about 135% off of as a percentage GDP.
Yeah.
We've now been bumping around, I would say, probably about 120%. What's your concern about debt, and also why is it particularly important right now?
Very good question. I think Japan is a great roadmap for all this. Japan right now is at about 255% of GDP on government debt. What if the US goes there? And if you look at the Japanese market overall, gold prices in Japanese yen are making new highs. And there's a very interesting divergence between that and gold in USD or US dollar terms. I think there's going to be a catch up to that as well. So in my opinion, the situation with the government is a huge problem. The agenda fiscally has never been so extensive. It goes back to the inequality issues, the green revolution problem, even the resource stuff. And all of that is creating even social programs that we're seeing that we didn't see in the past. And that government spending, it's only accelerating the pace of the debt issue. And so when you look at the treasury issuances happening right now, it's, in my view, probably one of the most important things that people should be watching for. That is precisely what is driving 10-year yields higher. It's not even, although I'm an inflationista right now, I think inflation is a problem, but I do think that what's driving 10-year yields is the supply side. And the way you look at it is because we're not seeing break-evens rise at the same time. Break-evens is the expectation in the market for CPI. And so if that's not rising, that means the excessive supply of those things have been actually driving yields higher. China is not buying, Saudi Arabia is not buying, Russia is not buying. And so who is going to be buying treasuries? I mean, we're not even seeing the banks buying those instruments anymore. So it's going to be some big challenges. And ultimately, the answer for that, in my view, is going to be the Fed, just like Japan. So Japan is a good model for this. And watching what's happened with gold in Japanese yen terms is very, very relevant for me, at least, from my thesis perspective as well.
Tavi, let's situate where we are right now. We're at the Precious Metal Summit here in Beaver Creek, and you have been meeting with a bunch of gold juniors right now. When I last counted, there was like well over 100 that are listed as being attendees at the show. You've been meeting with companies as well too. What's your checklist? What is a good gold company right now, and especially in this environment?
Well, the very interesting setup on the gold space right now, because I'm more involved with exploration and development, is everything is priced for failure right now, and that from a valuation perspective, assets that are high quality versus assets that are very poorly driven are actually priced at the same level. A lot of companies that we own that have already made discovery holes are actually trading below those levels right now, which is something that I think the markets are incredibly inefficient right now. And so sticky money will probably do very well here. The problem is there's no sticky money. There's a bunch of retail investors. The foundation of a lot of the companies that are here are still really bad when it comes to the number of investors that are coming in. They're not long-term, mentality is not there. And so there's going to be some issues here, but I think for an investor like a fund like ourselves, I think this is a great time to be trying to pick and choose which ones are those of very high quality, that have high discoveries, that are increasing the probability of having a world-class project that the market is just not appreciating. I am tired of seeing how many companies are putting out great results, and the market is just not really appreciating that at all. And that has been really the news of the last, 6, 12 months. And so if you have that long-term mentality, what a great time to be accumulating those assets that are high quality. So we've been trying to do that and meeting with some of those companies. And as we said before, I think there's a lot of opportunities to, the market is very segregated right now in the junior space, and it's making it very difficult for the large companies to really buy those juniors. We're going to have to be seeing some consolidation in some regions that are going to be key for the next projects of the next cycle. And so our focus is on that as well.
Help me out, Tavi. We had a conversation before this, and we were talking about what you prefer more, the producing gold companies, the GDX, which has been flat this year, the index of all of the gold producing companies, and then talking about the juniors. You were saying, I believe, that you prefer the juniors because while the GDX companies are down, the explorers are so beaten up that you're looking, when there's a spring, that's what's going to be happening.
Well, I think there's a chronic issue happening across most of the more established companies in the industry. I've been more vocal on this before, and it's basically has to do with the fact that a lot of gold miners are running away from gold. Most of the big gold miners in the space have been actually in a secular decline when it comes to production of gold. Surprisingly, that's precisely what happened in the bull market of the 70s, when annual production for gold was declining for a full decade, and it also happened in the early 2000s. And so history is playing out again here, where gold is becoming out of favor at a time when central banks are buying the asset. And on top of it, I think there's something else that is happening more macro, which is this sort of redefining conventional portfolios, the 60-40 portfolios. Gold is going to start becoming part of that 40%, creating that demand, just like central banks. And so going back to your question on the chronic issues of all that, well, I think that given the fact that there's more inefficiencies in the small caps and even private names, for companies like ourselves that really try to focus on unlocking value through different ways of more activist approach, I think there's a lot of things you could be doing right now. And so we've been, we have a lot of positions. And also the exploration side of this industry offers something that a lot of the majors don't offer, which is that sort of speculative environment when you have a discovery. And we've had a few names in our portfolios that have done very well. Newfound Gold, pre-IPO investment. Snowline Gold was another one recently. All you need is really one investment that does very well, that kind of pays off to your other bets. And they're not bets because they're investments on the long term. The fact that they haven't hit yet doesn't mean they just don't have anything. We'll continue to develop those projects over time. So if we think that there is a case there to be justifying the investment. So I think that's the case in a lot of our names. And I don't have a crystal ball, but I like to think that we're in the right place in terms of the industry segment of explorers.
Let's finish on macro. I'd like to bring it back on what the top trends that you're watching for. There's so many things that are happening right now. What's the decision that the Fed is going to make? What's happening with China right now? You're mentioning regarding debt levels. What do you think is going to be the economic trend? What is going to be the piece of news? What are you paying attention to the most over the next 12 months, Tavi?
There's so many macro trends unfolding in front of us. I think that the commodity trend is something that I'm paying very close attention to. Metals and mining is one focus. Obviously, that can branch out to many things, even uranium, electrification metals. Energy is something I'm very focused on as well. I think energy continues to be overall an issue in terms of supply, and what you're seeing in terms of the government policies with SPRs and other things, and even coming from Saudi Arabia, becoming more and more kind of a geopolitical commodity. There's going to be a lot of opportunities there. Agricultural commodities, I think, are looking very attractive as well. And in my view, maybe the most asymmetric way of playing all this would be looking for countries that have a more favorable economy towards commodities. And those are Brazil, in my view, is actually, I'm very skeptic of, I'm from Brazil, and I've been always skeptic of the country given the corruption scandals that we see every 3 to 5 years, or really every month if we would record it every day. But it's just, businesses are really cheap compared to FANG stocks here. I mean, FANG stocks, you're paying 100, 150 times earnings. Some of them don't even make money. In Brazil, you can buy established bank for 3, 4, 5 times earnings that have been in business for 30 years. I don't think they're going away. And so, if you get that sort of backdrop where commodities do very well, the country does very well, and then you have a favorable environment for banks as well, that's just one example of a place where you can invest your money. China looks very oversold from a macro perspective. I don't like China in terms of the kind of geopolitical environment, in terms of being a commodity importer and other things that doesn't fit in my macro setup. But I won't lie. I mean, things are really cheap there right now. It's not a focus of Crescat at all. The debt problem will continue to be a case. I think there's opportunities in the credit spreads, junk bonds. Junk bonds, are basically a major risk in my view. And there are ways you can kind of hedge that position over time. You can hedge the FANG stocks position as well. Why can't we not see a big decline in FANG stocks today if we have a reacceleration of inflation? Well, that's a very contrarian view in my opinion. And so I like those positions too. So there's a lot of things to kind of unpack. Even in the home builders look interesting. I think there's going to be opportunities in the residential market as well. So anyways, I don't want to extend too much, but I think there's going to be a lot of ways to make money. I get excited about metals and mining, but I think there's a lot of ways to skin the cat here. Tavi,
I understand you're a new father. Thank you very much for making time for Kitco.
Thank you very much. Yeah, I need time.
My name is Michael McCrae with Kitco Mining here at the Precious Metals Summit. Subscribe to see more news from Beaver Creek, Colorado.
Kitco Mining's special coverage of the Precious Metals Summit is brought to you by Nucor Gold.